Debt to income ratios. One of the main calculations used in determining how much housing you can afford. Simply put, it's a percentage of your monthly gross income that goes towards paying off your debt. Now there are two main types, often expressed as ratios, say 31 and 43. Now each loan program is going to have its own ratios, and some loan programs only have one ratio. But in this example, we'll focus on two. The front-end ratio indicates a percentage of your gross monthly income that goes towards your housing cost each month. Now, if you're a renter, that's your rental payment divided by your monthly gross income. If you're a homeowner, that's your PITI, that's your mortgage principal and interest, your property taxes, and your hazard insurance. Now, if applicable, it could be homeowners association dues as well as private mortgage insurance. In this case, you take that one payment with all those items in it and divide it by your monthly gross income to come up with your percentage. You want that percentage to be below that set by the lender. Now, the second ratio, the back-end ratio, is the same exact thing as the front-end ratio, but in addition, it has all of your recurring expenses. Now, these recurring costs are items such as loans, your vehicle loan, student loans, personal loans, credit cards. Now, if credit cards are looking for that minimum payment amount that's due each month, they could be items such as alimony and child support and legal judgments. Now, calculating your back-end ratio, you want to take the dollar amount that you got for your front-end ratio for your total housing cost each month. You want to add in your total recurring costs, the total from all your loan payments, vehicle payments, and such as. You come up with a dollar amount, you divide that by your gross monthly income, and that will give you your back-end ratio. Again, you want to make sure you're below that ratio set by the lender. Now, there are many more payments each month that you're obligated to. There's things such as utility bills, your water, your trash, your electricity and gas, your phone bill, your cable bill, insurances such as life and automobile. Although those are really important in calculating your payment as far as your comfort level, you want to find out what you're comfortable with, it's not required in calculating your debt to income ratio.
I'd like to now give you an example of something on the computer just so you can get a better visual of what I was speaking of. Debt to income ratios and how to calculate them. On a monthly impounded mortgage payment, you have your principal and interest, your taxes and insurance, which is referred to as your PD, your PITI. And then some may have HOA dues as well as private mortgage insurance. You want to add up all those items and then come up with your total monthly housing expense. For an example, I'm going to use a $2,000 mortgage payment that has all these impounds in there. The next thing that we want to factor in is your gross monthly income. So I'm just using an example of a $75,000 gross income coming in. It could be from two couples combining a gross of $75,000. It could be one person, $75,000. We're looking for the gross monthly household income in this case. We'll want to divide the monthly housing expense by the gross monthly income, and that will give us our front-end ratio of 32%. Now for the back-end ratio, we're going to take the same exact housing expense that we used in the front end, and then we're going to look for other recurring debt as I was speaking about. So in this case, car payments, credit cards, and student loans, these other debts are going to add up to $700 for this example. Now these are all just figures I threw in there just to give you an idea, but we take the monthly housing expense plus the other debts of $700. That's going to give us a monthly debt of $2,700 for the back-end ratio. Now to calculate that, just take the $2,700 divided by the gross monthly income, in this case $6,250. That's going to give us the 43% for the back-end ratio. Now the two ratios we calculated gave us the 32-43. So what I'm going to do as a mortgage broker, I'm going to look at the loan products out there. The first one as an example, FHA conforming, FHA requires a 31-43 debt to income ratios. Well, I look at what we just calculated for this example, we got a 32-43. The 32 is actually over the limit set by FHA, which is 31%. The 43 was right at it. So this one, because it is over the limit, this would not be eligible. Looking for another loan program, we have a Fannie Mae product, conforming loan. This lender requires up to 45% debt to income ratios. They only have one ratio here, so we'll just want to use that as a 45-45. So the front end ratio, 32%, is well under the 45%. That is good. The back end ratio, 43, is also under the 45%, so that is good. In this example, with our ratios of 32-43, the Fannie Mae product would be eligible. There's many other things to take into consideration, but as an example, I'm talking about debt to income ratios today. This will let you know how to calculate that. FHA conforming 31-43 doesn't fit in there. The Fannie Mae conforming, in this case, it is eligible for that program. That was a quick rundown on debt to income ratios. If you would like more information on that or any other loan products, please feel free to give me a call or shoot me an email. I'd be happy to return either one.